Hey, my name is James Nicholson and welcome to my YouTube channel. Mortgage arrears are massively up according to a new report from the Bank of England. I'm going to tell you exactly how much they are up and how does this compare to 2008, which is the last time we had a major property crisis. You probably remember the credit crunch, I'm sure. So this video, I'm going to dissect exactly what the Bank of England's saying. Should we be worried? Are we close to those 2008 levels? Well, I'll dissect all of that and more in this video. So before we jump into this, as always, if you haven't done, subscribe to the channel over there and hit the bell notification. We're close to 25,000 subscribers now. You could get us there that little bit quicker. And smash like, tickle like, do something to the like button. Hey, if you're one of the people that doesn't like me asking that, do it out of anger. Just do something to that like button. That really helps me with the YouTube algorithm. It gets more views on the channel and grows it for everyone. So thanks to everyone that does that. So it's quite sobering, the Bank of England report. And this is in all of the big newspapers over the last few days, Financial Times and that sort of stuff. A lot of economists are saying that, look, it's time for the Bank of England to cut rates. I also feel that because the inflation that we've had has been supply side inflation. We couldn't control it. It wasn't our spending. It wasn't consumers recklessly spending on holidays and cars and all of this kind of stuff. It was energy costs, and we don't control that market at all. And so keeping the rates higher for so long is partly because of energy costs are still high and potentially they're going to come back. But is that going to make you or me spend less? I don't know. But a lot of people are saying it's time for the Bank of England to start cutting rates. So what is going on with arrears? Because maybe if the arrears are getting to unsustainable numbers, then the Bank of England will start to cut rates. So this is the Bank of England data. And so they're saying that mortgage arrears are now the highest since 2014. So 10 years, the highest in 10 years. How bad are they? Well, for the first quarter of this year, they increased 4.2% increase, which is a hell of a lot. And that's because a lot of people are coming off fixed deals, and some of those people can't get a new deal. Maybe they lost their job, for example, and so they're struggling to get a new mortgage. They might be sitting on a high variable rate with that bank, which could be 8%, 9% in some instances. And so that could be causing them major problems. Or maybe they've just gone from a low rate to a considerably higher rate now, and that meant affordability just isn't there for them anymore. And so that is really quite bad. Now, the previous quarter, the arrears was 21 billion. So banks will struggle. If that does not get paid back, you could start getting a banking crisis again, and then banks will stop lending and we could get 2008 all over again. Now, the total arrears at the moment that we've got in the UK is 1.28%. Doesn't really mean much to a lot of people there. Is that low? Is that high? Well, that's gone up 4% in the quarter, as I said, but comparable to 2008, which was the last major crisis that we had in property, is actually quite low. So in 2008, the arrears was 3.4%. 3.4%. So more than double, nearly triple what you've got right now. But we're moving quite quickly towards that 3.4% number. And so we've got to keep an eye on this because a lot of people are feeling a lot of pain, and I feel it's unnecessary. I think rates should start coming down. Inflation is likely to drop again next week, and we just need to just start giving people a lifeline, like give them some support, because what could happen is if the market suddenly crashes, then we go into a recession, they'll just slash the interest rates. Rather than just slowly bringing them down now, we could get a soft landing and everyone would be in a much better position. Now, why could now be different to 2008? Well, I borrowed money in 2008. I've been property investing since 1999. And 2008, or prior to that, 2006, 2007, you'd go to your broker and just tell them how much you earn. Like, there was no real checks done. Particularly if you were self-employed, you had a mortgage called self-certification, right? You just said, I earn this. They didn't even get your pay slips, didn't even check your bank statements really. And away you went and you got to borrow as much money as you could. Now, what you could also do back then is you could borrow 110% of the value of the property. So you got a 100 grand house, they'd lend you £110,000. Now, that was based off that you'd maybe do some work to increase the value. Lots of people didn't know. They just took that 10%, bought cars, went on holidays, and then they couldn't afford to keep up with the payments. That was the problem. And these were called subprime mortgages. Same thing happened in America. And so people were getting mortgages that couldn't afford it. They were getting more money than they could afford. And eventually their house went into negative equity. That 100 grand house became worth £70,000. Now they owed 110, but the house is worth 70. So some people just said, take it back, have the house. I don't care if you make me bankrupt or put CCJs on me. I don't want the liability or the debt. That caused the banks to then go bust and caused the financial crisis, which was an absolute disaster. Now things are very different. So this time round, I think we've got lower arrears at the moment. Even with the 14 consecutive interest rate rises that we had, we've got lower arrears because it's hard to get a mortgage. I've got a portfolio of property. I've got a decent loan to value, as in a low, less than 50% loan to value on my portfolio. And still, every mortgage I do, I have to provide all the bank statements, my income, my expenditure. They have to look at the risk of my portfolio. And even if I got just a residential property, it's really tough to get a mortgage, and it has been because of the credit crunch. That meant that people were tested, stress tested. Could they afford 6% interest rates, which they now have to? Obviously some can't, but initially when they applied for the mortgage, it was tested, should they be able to afford it? And that was the decision made on that, on how much they could borrow. And so we have a more robust process. But if people start losing their job from a recession, then it's irrelevant what they were stress tested to. They won't be able to pay their debt. So this is a figure that we should keep an eye on, because if this ticks up much more, you will start to see house prices come down quicker. You'll get more distressed sellers that will go onto the market that need a quick sale, and that will drive prices down. Let me know your thoughts on the Bank of England data. Do comment below. I love all your comments. I reply personally to every single comment on the channel, even if it takes me to 11 o'clock at night. So do take a moment to do that. Do smash like, do subscribe. Go and check out some more content on my channel, including this video right here.